The DSCR appraisal problem nobody talks about. One of the biggest things that kills DSCR deals has nothing to do with the borrower. It's the appraisal. And most investors don't realize how much power the appraisal actually has in DSCR lending until a deal starts falling apart because of it. Hi guys, this is Sal Bossio with Mortgage Universe on YouTube. And this is something I think a lot of investors completely underestimate when they first start getting into DSCR loans. Because people hear no tax returns, no income docs, property cash flow, and they think the process becomes easier across the board. Not exactly. The reality is, in DSCR lending, the property becomes incredibly important, and that means the appraisal becomes incredibly important as well. Not just the value, but the rent value. That's the part most people don't fully understand, because on conventional financing, the appraisal is mostly about just supporting value. On a DSCR, the appraisal is often supporting both value and cash flow. That's a massive difference, because the lender is literally using the property's projected income to help determine whether the deal qualifies. So now suddenly, every little detail about the property matters. Location, rental demand, property condition, comparable rents, short-term rental viability, property uniqueness, rural versus suburban, condo restrictions, HOAs, all of it. And this is where things get interesting. I've seen investors buy what they think is an incredible investment property, then the appraisal comes back and completely changes the deal structure overnight. Maybe the value comes in low. Maybe the rent schedule comes in lower than expected. Maybe the Airbnb income projections don't support what the investor thought the property could generate, and suddenly the DSCR ratio drops. Now, maybe the borrower needs more money down. The rate changes, reserves increase, leverage drops, or the deal just doesn't qualify at all. That's why I keep telling investors, you're not just buying a property, you're buying an appraisal story. That's especially true in DSCR lending. And by the way, if you guys are into conversations like this, DSCR loans, real estate investing, scaling rental portfolios, how lending actually works behind the scenes, definitely follow along, because I'm going to be diving way deeper into this stuff. So go ahead and hit the like and subscribe button. Now, short-term rentals make this even more complicated. This is where a lot of investors get blindsided, because not every lender analyzes Airbnb income the same way. Some lenders use AirDNA projections, some use appraiser projections, some cap income aggressively, some only use long-term market rent. That's a huge difference. You could have an Airbnb property generating incredible real-world income, but if a lender's appraisal methodology doesn't support it correctly, the DSCR ratio can still become a problem. And then you've got unique property types. This is another thing nobody really knows about or talks about enough. Everybody online loves showing like cabins or tiny homes. Someone just came to me with a barn dominium, rural properties, unique Airbnbs. But the more unique the property gets, the harder the appraisal can be sometimes, because appraisers need strong comparable data, strong comps. And when there aren't enough strong comps, or comparable properties nearby, rather, things can start to get messy really fast. That's when lenders start getting nervous. And honestly, sometimes investors focus so heavily on the property itself, they completely ignore whether the property is actually financeable in the DSCR world. That's a huge mistake. A property can be beautiful, profitable, desirable, and still create financing problems if the appraisal doesn't support the story correctly. That's why experienced DSCR investors eventually start thinking differently. Like, they stop asking, do I like this property, and start asking, well, will this property appraise, or will it appraise well for DSCR lending? That's a completely different mindset. And another thing most people underestimate is how much appraisers themselves varies. Some appraisers understand investor properties extremely well. Others are much more conservative. So sometimes it's a little bit of a guess on who you're going to get. Some understand short-term rental markets. Others, barely understand Airbnb economics at all. That can completely change a deal. I've literally seen scenarios where same borrower, same property, different appraiser, and the outcome changes dramatically. That's how important this part of the process becomes, and this is why lender selections matter so much too, because some DSCR lenders are way more experienced with short-term rentals, investor properties, unique assets, non-traditional scenarios, right? While others are much more conservative. It's almost like every lender has a different appetite for complexity. And what's crazy is most investors don't even realize these differences exist until they're already deep into a transaction. The bigger shift happening here is that DSCR lending is becoming its own ecosystem. It's not just, here's a mortgage. There's now strategy involved. Property selection strategy, cash flow strategy, appraisal strategy, lender strategy, reserve strategy. That's why I keep saying the investor who really learns this world early are probably going to have a massive advantage over the next decade. Because once you understand how DSCR lending actually works behind the scenes, you stop thinking like a retail borrower and start thinking like an investor.